Great. So in today's section, we are going to look at for the discounted cash flow technique. Yes, discounted cash flow techniques. That is the section that we're going to look at for today. So tell the alumni that we are looking at for discounted cash flow techniques. Basically, what the discounted cash flow techniques assume is to discount the cash flows before finding their present value. That is what we are going to look at for how we could probably discount the cash flow. You know, the discounted cash flow techniques, the good news about it, there are a lot of good news. So let's look at the advantages. The discounted cash flow techniques basically discount the cash flow, take into consideration the time value of money. You know, if you are assessing a project and this project, let's say year one, it can probably give a cash flow of, let's say, 30,000 to 60,000. Now, if you don't discount this cash flow, it means that as at now, you've estimated that at the end of year one, you get 30,000. And it's the same value today. And you know that 30,000 in 12 months' time is the same as 30,000 today. So that is why there's a need for the discounted cash flow techniques, meaning that we need to discount the cash flows. That is it. Okay, so now let's look at some good news about the discounted cash flow techniques. Advantages of discounted cash flow techniques. So the advantages of the discounted cash flow technique. Advantage number one, we can give two straightforward. Tell the examiner that it uses cash flow instead of what? Profit. So it's based on cash flow, or it uses cash flow and not profit, or instead of profit. Why is it a good news? It's a good news because it is easy to manipulate profit than cash. Cash is not easy to be manipulated by what? Subjective accounting policies. Good. Tell the examiner that it uses the time value of money. So it considers what? The time value of money. So there's the time value of money. Meaning that $1 today might not be the same as $1 in future. Let's say 5 years, a year, or just in the near future. That is the good news number two. These are the main good news about the discounted cash flow techniques. Good. And then all the discounted cash flow techniques is what we call cost of capital. It is cost of capital. It uses cost of capital, meaning that it discounts the cash flows. These are the good news that we are going to look at for. Now, number four, we can say that most of the discounted cash flow techniques uses or considers the entire cash flow. Most of these methods consider the entire cash flow. Yes, let's look at some difficulty or disadvantages. Let's look at some two. Number one, some challenge about the discounted cash flow techniques or disadvantages. So we have four of the advantages, and let's look at the disadvantages. Challenge number one, it assumes that the cost of capital is fixed or remains constant at all levels of activity. Well, it is not true. So it assumes a constant cost of capital, which is not true. And then this one, I'll group them. The cash flows and the cost of capital. All of them are made up of estimates. So in short, the cost of capital is being estimated, which might be different from the actual cost of capital. The cash flows too is based on estimation, which must also be different from the actual cash flows. So basically that is that. Now let's go straight and look at the methods that we should look at for under the discounted cash flow techniques. For the purpose of our studies, the methods are only three. Let's look at these three methods. Let's look at these three methods. First of all, we need to look at for the following three methods and look at them carefully. The methods are, so there is discounted cash flow technique. The method are only one, adjusted or discounted payback period. Adjusted or discounted payback period. Number two, almighty Mpv, net present value. Number three, internal rate of return. So I'll start with the adjusted payback period. It's the same as what we did last week. If I've not gone through, can you pause the video and go through last week's own or the previous video before this? Okay. Rather. Now, the adjusted payback period is the same as the payback, but here we are just going to discount the cash flows. That is the difference. So the cash flow needs to be discounted. That is the main aim. So let's fix a question in here. First, to look at it, how we can discount the cash flows. Discounted cash flow means you need to find the present value. The present value of it. So let's look at this example or this illustration for the material. So assuming that we are using discounted cash flow techniques, how are you going to make a decision out of the following data? Okay, so the data goes like this. Target publications considering a new project requiring a capital outlay of 140,000 cities on equipment and an investment of 20,000 in working capital. The project will have a 4-year life with an estimated residual value of 5,000 cities. The project is expected to earn the following net cash receipts. Now, one thing too about the discounted cash flow technique, including the adjusted payback period, it uses cash flow. That's the good news about it, cash flow. And thank God this one's about also cash flow. So they have provided what we need. Okay, so that is it. The cash flows are there. Now let's try the exam now. We are calculating what the adjusted payback period, or it's also called discounted payback period. It's a special type of payback where the cash flows are discounted. That is all. So I'm calculating adjusted payback period. No shortcut. I'll start with a year. I'll start the cash flow. I'll go by discount factor and go by what present value and go by balance. How we get it? So first of all, year cash flow discount factor, and then the present value and the balance. Then the balance, basically. Then the balance. Okay, so let's produce some few issues in here. We said that once is a payback, we start from year zero. Once the payback start from year zero. So we list year zero, year one. So 0, 1, 2, 3, and then 4, right? Okay. 0, 1, 2, 3, and then 4, right? Yeah, this one's okay. Okay, so what are the cash flow for year zero? Let's go to the question and record it. So the cash flows there. Let's start from year zero. Year zero, all the initial outlay plus any working capital. So year zero will be 140,000, the cost of investment, plus the working capital of what 20,000. So putting the two together, you get 160,000. So here will be cash flow 160,000. Put it in brackets. 160,000 should be in brackets. Let's go to year one and pick year one's cash flow. Okay, 1948, 1925. So 1948, 90. So 1948, 90. The last year, if there's a scrap value added to the last year's cash flow, if there's a working capital, also add it. Last year, we have scrap value of 5,000, working capital of 25. You add it to this 25. So at the end of the day, you get 50,000. Okay, so basically, so you add 20 plus 5 plus 25, making 50,000. So the last year cash flow was 50,000. That is all. Then we find the present value. We look for the discount factor. Here was the cost of capital. They have to give us the cost of capital. Because we said that all the discounted cash flow techniques uses for the cost of capital. Okay, so the cost of capital was not given. In fact, it was given to be 10%. This is the question that we are doing. Okay, so using the data in example 3, okay, let's assume that the cost of capital is 12% from the example that we are doing. Let's assume that the cost of capital is what 12% in here. Let's go to the board. Cost of capital is 12%. That's for the discount factor, the old one. And then in that order. The discount factor will be provided as follows. So it's 1 divided by 1.12. This is the power 1 if you're at year 1. The power 2 if you're year 2. 3, 4 in that order. Good. Okay. So year 1, the discount factor is 0.797. So year 2 will give us, let's see. Year 1, I will not agree. Should be 0.893. 0.893. 0.893. The discount factor for year 1. Okay, year 2 is 0.797. 0.797, so it was 797. Year 3 happened to be 0.712. 0.712. Then we're going for the last one, the year 4. 0.636. 0.636. Now let's the present value by multiplying. 160,000 times 1 will still give us 160,000. Agreed. 90,000, 90, 1, 2, 3 times 0.893. So get something like 8370. 8370. So the next year will be 38,256. Let's see the year 3. Year 3 will be 90,123 times .712. 64,080. 64,080. And finally, year 4 will be 50,123 times dot 636. So basically, you get something like 31,800. Right after getting the cash flows, let's quickly look at the balancing. As at the start of the project life, we need to clear 60,000 off. So we still have 60,000 hanging. At the end of the first year, we had some cash of 80,000 and 370. Let's use that one to offset some. So it means that when we take the 80,000 each, the 80,000 to offset some part of the 160, what will be the remaining balance? So the remaining balance will be 160,000, 1, 2, 3, less the 80,000. So the 80,000, 370, right? 79,630. So 79,630. So this is the balance left. Then again, we have 38,000 in here. Let's use that one to offset some of this. So let's 38,256. Basically get 41,374. 41,374. Then it will be cleared here in the third year. So let's quickly calculate the payback period. Okay, so in this scenario, the payback period will be, let's look at the payback period. Let's look at the payback period. Okay. So the payback period happens to be payback period. We have to be clear here. We are doing adjusted payback period. So that is adjusted payback period. It will be, if I want all in years, it will be 2 years because I have 2 full years here. This and this full, but this one is not a full year. We only pick 41 out of 64. 96 plus 41, 374 out of 64. 80. Then add your years to it. So that is how we will calculate the payback period. The adjusted payback period. Great. Let's quickly move on to the next level. We can also express it in what? Some 2 years and something months. And what? 2 years and 41,374 out of 64,808 times 12 months. So something like this too will also work perfectly. Let's do the analysis. Well, like if you want some years and then month, 2 years and what? 41,374 over 64 and 80 times 12. And that will probably give us something like that. But if you use 10% discount factor, this is how the result will be. If you use 10%. We use 12%. So now you realize that it will increase. It will increase the issue a little by little. Let's see something in here. The only issue is that this particular one, we have updated the cash flows a little. The cash flows has been updated a little. This particular one. So take note of that. Here instead of 90, 48, 90, and what? 50. So that is that. Okay, now we are done with the adjusted cash or discounted cash flow techniques. Basically, the cash flow needs to be discounted, and then we move on. Okay, so that is that. Yeah. Okay, so now we are done with the adjusted payback period, meaning we are heading towards the NPV, net present value. NPV. Let's quickly provide a summary to MPV, and let's continue the game. Let's provide a summary, and let's continue the game. NPV simple means net present value. Net present value. Net present value. That is NPV. Now, the Mpv approach, as the name suggests, net present value. It means that it is the PV, present value of net means inflow minus outflow. So all the inflow one side, less outflows. That's the meaning of net. All the cash inflows one side, less cash outflows. So take note of that. And then you find the present value of this answer. That is all. That's what we mean by what net present value. So here you are going to assess the project based on the cash flows that the project will generate. The cash flows that the project will generate. That is the MPV. Okay, basically. Now, present value of inflows less PV of what? Outflows, basically. Inflows, example of inflows. Give an example. It can be one, sales, revenue, fees, or receipt. Number 3 will be savings, or the savings in heating cost can also be an inflow or economic benefits, any benefits we would derive, versus outflow. Outflows are what? Variable cost and other operating costs and other incremental costs. And then contribution forgone. Good. So basically, these are the item that we are going to look at for, basically. Now let's see the table. Now the MPV comes with what? Table, like layout, a format, how we should draft it, like how you prepare the operating statement. The same way we prepare the MPV layout. Okay, so the layout depends on the information you have in the question. Some layouts are a bit comprehensive, and then you have a lot of items in there. Okay, so basically, let's see the MPV layout. Then the examiner, we are going to look out for MPV layout. It's a very lengthy item that need to start from the top. MPV layout. MPV layout. MPV layout. So first of all, we start with year 0, year 1, year 2, up to the final year. Final year, or the project life. In the project life is 5 years. You have year 5, 6, up to year 6. You start with your sales revenue. Sales revenue, or the receipts. Either the sales revenue, receipts, savings, fees, get them in. So much. First, less your variable costs. Variable costs. So much. You get what you call contribution. But normally I continue the game. I go to less incremental fixed costs. Incremental fixed costs. And I'll move on. I'll subtract that one too. Then finally, I'll get what you call cash profits. Call this one cash profits. Cash profit, or you can just call it profit. But it's a cash profit. So profit, so much. That examiner. Thereafter, you calculate your tax. Now, watch out for the tax. There are 3 scenarios when it comes to tax. Number 1, the easiest one. Tax is paid in the same year when profit arise. Taxes paid when profit arise. So it means that tax is paid the same year. That's the meaning. If we are paying tax the same year, just find the tax rate given to you in the question. Not always it will be 30%, no. It will tell you the percentage in the question. Stack it on these figures, and that is all for the tax. So hoping that these figures will be correct. This one will also be correct. Okay, so right after that, then move on. Now let's go to the second scenario where tax is being paid 1 year in arrears. Tax is paid 1 year in arrears. Meaning that year one tax will be paid when? Year two. And that is reality. Year two tax will be paid in year three, in that order. And when this scenario appears, it means that we need to create an extra room for tax purposes or create extra year for tax purposes, because it will sound like this. If tax is being paid 1 year in arrears, year one tax will be paid when? Year two, good. Year two tax will be paid in when? Year three. And then finally, year three tax have to be paid in year four. Year four in year five. Year five in year what? Year six. For the tax purposes, we need to create an extra column for tax or extra year for tax. Okay, so basically, right after the tax, together with the tax cash flows, then you go to what you call tax saved on capital allowance, tax saved on capital allowance. Now, it must move in line with your tax cash flows. If you pay tax 1 year in arrears, kindly lock it 1 year in arrears. That one is positive because that one is a savings, and savings are what? Inflows. So that is it. Then we move on to that of working capital, which have its own 3 rules. Working capital. So we need to look at working capital. And working capital, we need to start from the first column, that's GSL, put in brackets. And the last year's own is positive. So you can leave it like this, working capital. And right after working capital, we will bring what you call the scrap value of the asset, the after tax scrap value. The scrap value. That one dash the last year you put it there. Then finally, cost of investment. Cost of investment. You bring it here, negative dash. You double or you now align them, put all of them together. We call it net cash flow. And the discount factor continues. The discount factor, let's say 10%. You get it, you multiply. Now find the PV of the cash flows. Present value of what? Of the cash flows. So PV of cash flows. You don't want to line it, meaning that we are done with the game. And you basically sum up, you sum them up horizontally to get overall figure. Good. So basically, we need to explain the items in here. All these items we have notes under it, and we did them under the relevant cost approach. So we will move on over here because we've done it. So we have what we call relevant cash flow. It is the same as the relevant cost that we did. So take note of that. Now relevant cash flow. we have what we call relevant cash flow. It's the same as what we did under the relevant cost. So some of the cash flows are relevant to the Mpv calculation, and for that matter, they need to be present in the Mpv calculation, or they need to be part of the Mpv calculation. Some of the costs too, they are what? Irrelevant. So those that are irrelevant, ignore them. The relevant cash flows they have three features. One, the cash flow must be in the form of cash movement. So it must be cash flow. Number two, it must be in future. Number three, it must be incremental or incidental. So incremental or incidental. So these are the features of the cash flow that's relevant to the Mpv calculation, or these are the relevant cash flows. It might be of cash flow, so here ignore all non-cash items such as what? Depreciation and provisions. So do not include depreciation in Mpv calculation, not at all. Number two, cash flows must be in future. It means that the past costs, past and what? Sunk costs are irrelevant. Past and sunk costs are what? Irrelevant. Example of past costs and sunk costs, they are feasibility studies, research costs. All these costs are what? Past costs, or they are sunk costs. You don't need to include them. So feasibility studies, sunk costs, research, all of them ignore. The last one is incremental. Incremental means big cash flow that are directly incidental to the project. And those cash flows, it means that we don't need to include what you call general cash flows. No. General fixed costs need to be ignored. The only fixed cost that we like, we call it incremental fixed cost. We call it incremental fixed cost. So the only fixed cost that we like is the incremental fixed cost. That is the only fixed cost that we like. Okay. Incremental fixed cost. So take note that aside this, we are not interested in the other cash flows. Aside this, we are not interested in the other cash flows. Aside this, we are not interested in the other cash flows. Basically. Okay, so that is that. Now let's start our first question. I'll solve a question called adjust scope. That's the first question that we will solve. Adjust scope. Let's go to the material and pick adjust scope. That is, it's November 2017. Question number 1. If you do have a particular set of questions, you can find in there. So you can find it there. Okay. It's in the material. Let's go to Papa adjust scope. So the Mpv layout is in there nicely for you, and all the items are displayed for you. the relevant costs, everything is explanation rule. Advantages, disadvantages, plenty. And give the critical question in here. Can you follow the critical question? Okay. So take note of this. For instance, look at the question. They are saying the directors of Target Communication Limited is considering installing a new plant in one of its first house. One of its first houses. Production of student magazine. Research and feasibility studies are conducted by a team of personnel at a cost of 100,000 to be able to determine the cash flows that are likely to arise from the projects. It doesn't matter whether the research was to gather all this vital information. We still don't consider the research cost as what? A relevant cost. Ignore this. Do not include it. That is all. Okay, so that is that. Let's go look at from a part just for. But for this, I've solved it in. So you have to probably try that and follow it for me. But just try you. Just go. I just is not here. I just is not here. You just no. I just go no. Go to the tutorial question. I just go with the just question. So this is Ajasco Limited. Let's go to the question. Calculate the net present value of the proposed investment and comment on your findings. So what we have to do is go through this. So Ajasco Limited is a software company and has developed a new game called Lando, which it plans to launch in the near future. Sales volumes and production volumes and selling prices for Lando over the 4-year life are expected to be as follows. So all of them are there. Financial information on Lando for the first year of production is as follows. Direct material cost 5.4 per game. Variable cost, variable production cost is 6 cities per game. Fixed cost 4 Ghana cities per game. Advertising costs to stimulate demand are expected to be 650,000 in the first year of operation or production, and 100,000 in the second year of production. Advertising costs are expected in the third and fourth years of production. Fixed costs represent incremental cash because not every fixed cost that we're interested in. We're only interested in what? Incremental fixed costs. If you incremental fixed costs, ignore. The fixed cost represents incremental cash fixed production overheads. Lando will be produced on a new production machine costing 800,000. Although this production machine is expected to have a useful life up to 10 years, government legislation allows Ajasco Limited to claim the capital cost of the machine against the manufacture of a single product. Capital allowances will therefore be claimed on a straight line basis over a 4-year period. Over 4 years. Ajasco Limited pays tax on profit at a rate of 30% per annum, and tax liabilities are settled in the year in which they arise. Jasco Limited uses a discount rate of 8% when appraising new capital investments. Ignore inflation. Very lengthy, where we start from? Good. So we need to get our sales revenue. So they produce 150, 70, but this figure is supposed to be 150,000, 70,000, 60,000, and 80,000. Good. Some results started to disappear. Okay, so if you look at the selling or the sales revenue, just multiply the selling price by what out of the production units. That is all for each of them. And let's go. So can we do that as working somewhere and provide me with the final answer? Then you go to the variable cost. Kindly sum all the variable costs together as one. Kindly sum all the variable costs together as one. So add the material cost of what? 5.4 plus the other variable cost of what? 6. So that will give us 5.4 plus 6. That should be 11.4 per game. That is all. Kindly do not add the fixed cost. Fixed cost and variable cost, we cannot combine them. So they must be on their own. So the variable cost, let's go to the board, provide some few workings there that we get out here. The rest is just adjustments that we have to look out for on that is there. So adjust code. Adjust code. So Mpv layout, adjust code limited. Mpv layout. How many years? 4 years, right? So year 1, year 0, 1, 2, and then year 4. So let's see something in here. We will start from sales. Kindly join me with the calculations. So sales first year sales 150,000 by 25. So 150,000 by 25. So 25 by 150. That should be, let's create 3 zeros. So that should give us 3750, right? Let's raise 3 zeros on top. We are reporting in thousands of cities. Thousands of cities. So this one give us 3750. If I should be 1, year 0 should be 0. Because there's no sales revenue for the year 0. Okay, so that is that. So year 4 give us 1320, 1320. That is year 4. Year 2 give us 1680, perfect. 1680. And year 3 will give us 1380. Now, I know that probably a hand is suffering from what you call pupumiasis, meaning that so I have to realign and make sure that I present them nicely. In exams, you can also leave it like that. I don't want trouble, so let me read my lines. Let's go to variable cost. Variable cost to happen to be 11 per game. It's 11.4. So let's multiply 11.4 by all the items. The units, the first year is 1 50. So 150 by 11.4. And that'll give us 17 tenths. 1710. So 1710. 1710. Okay, so what about the remaining? Get 279 798. Year 3 happen to be, but year 3 and 4 will be the same. That'll be 60, 60. That's 684. 684, 684. We should put it in brackets. Let's go. Is there any fixed cost? Is there any fixed cost in the question? Let's go and pick the fixed cost from the question. So the fixed cost is 4 per game. So how do you get a fixed cost? Now this particular question, the only challenge was the fixed cost. Now tell me how you get a fixed cost for this particular question. Now for the fixed cost, we cannot be multiplying 4 by 150 by 70 by 60. No, if you do that, you've changed it to what? A variable cost. Fixed costs remain fixed within a relevant range. So here there are 3 acceptable methods. Number 1, look for the highest units. Number 2, you can also use the first unit. Number 3, use the average. That is all. Let me write them on the board. If you go and then the fixed cost is expressed as per unit, and you are looking for the unit to be multiplied by 1, 2, 3, 4. No, 3 method. Either use the first year, either use the average, that is the highest. That is all. So first year, average, highest. Any of them, you are free to go. But I like the highest. Yeah. So here, what is the highest value? Thank God it happened to be the first one. So multiply 150 by 4, and that is the fixed cost, incremental fixed cost. 150 by 4 give us, so 150 by 4, that should be around 600, right? So that means the incremental fixed cost will be 600 throughout. Tell the examiner, incremental fixed cost, bracket 4 Ghana cedis by 150. And now give us 600 throughout. Fixed cost is fixed within a relevant range of outputs. Do not convert a fixed cost to be a variable cost. Let's continue the game. If you do have any other fixed costs, they said that advertising cost to stimulate demand expected to be what, 650 the first year of production, and 100,000 in the second year of production. So basically, we can include that. So let's go do that.